Welcome to Keep What You Earn, your judgment and jargon free zone for entrepreneurs of all levels. Get ready to learn how to scale your business, save money in taxes, and create a business that grows your wealth. If it feels like the financial side of business is like eating your vegetables, well, then think of this podcast as the ranch dressing to make the process a little more enjoyable. My name is Shannon Weinstein. I'm a CPA and business owner on a mission to simplify money and empower others through knowledge. I hope this episode inspires you to take action, but remember that the information we share is for educational purposes only and is not individual tax advice. Now that we got that out of the way, let's start the show. So, a lot of the times when we're starting businesses, we start with a service based business because it seems to be easier or it's just something with a lower barrier to entry. Product based businesses are much harder to start. They can be very rewarding and very lucrative and more consistent. However, starting a product based business requires a lot of upfront capital. It requires a lot of testing, a lot of patience, a lot of logistics, supply chain, all of the things that come along with selling an actual physical product. I feel like it can get to market a lot slower than, say, a service. You could wake up today and offer a service. You couldn't just offer a product right away. You wouldn't be able to deliver it tomorrow, right? So a lot of folks steer clear of product based businesses when they want simplicity. However, it's really becoming a trend now to offer some type of product component in your business. So, in looking at product businesses, we see a lot of entrepreneurs starting their own product lines or diving into the product space with various celebrities now getting into this and other successful business owners offering products. It can seem like a really popular trend. But what I want to caution you on with products is that you don't typically measure your performance the same way. You don't typically evaluate your financials the same way with a product. You have to be ready to completely shift your mindset in how you think about your numbers. You have to be ready to measure different metrics. You have a different scorecard, basically. And I want to walk you through three of the key metrics or three things to just look out for in your product based business, or if you were to offer a product specifically in your product channel, in your product line. This is what you should be looking at to measure if it is successful or not. And there are more metrics than this, obviously, but I think these are some of the top three that will indicate if you have any type of risk or if you're heading on the right track. Number one is gross margin. You've heard me talk about this metric before, this financial line item on your profit and loss. And gross margin is really important, especially for product, because gross margin, aka gross profit, means how profitable your product is before you spend any money on those operating expenses like your service providers, your rent, or advertising, or things like that. Is your product at its core profitable? Meaning, do you have a price that is bigger than their cost? Very, very simple. This is like the bare bones concept of profit, right? So if you sell a widget and it costs you $3 to make and you're selling it for 5, you have a $2 gross margin. That's basically how it works, aka a 40% margin, 2 out of 5. So what you want to do is figure out if your gross margin is a positive. That's a start, because if your gross margin is negative, aka you're selling it for less than your cost, you are just giving away money. So we want to make sure that's not the case. Number 2 is you want to make sure that that margin is going to be enough to cover your operating expenses. So you have to kind of look at these tiers along the way of your profit and loss from top down. So you're bringing in this much revenue. Then you're spending money on the actual product itself to actually make it and deliver it to your customer. Now, this can include shipping and freight and other things too, right? In this cost of goods sold, we call it, to get to your gross margin. If your gross margin is, let's say, 20%, for example, if your gross margin is 20%, that doesn't leave you a whole lot of wiggle room to spend money on operating costs, right? To pay salaries, to pay for advertising. It doesn't give you much room. So you want to make sure that your gross margin is at a level where it's sufficient to cover all those operating expenses so that your net margin is still positive and that you're able to take some money home, because isn't that the point? It directs your expenses, your gross margin. It directs how much of a budget you have in order to spend on building your business. And it can help you evaluate the effectiveness of your pricing. Like, is your price high enough And are there any other dials, any other things that we can control, any other levers we can pull to make sure you're profitable? So gross margin is huge. Gross margin is a great indicator of just core profitability, and it's something that a lot of investors look at to make sure that you have a viable product in and of itself, even if we strip away a lot of the operating expenses. Okay, then the second thing you want to do is you want to have the capability to analyze trends over time based on what we call SKUs of your product. Now, SKU is spelled SKU and it stands for stock keeping unit. A SKU is a fancy way of saying a variation. So, if you have, let's say you have a product and it comes in 5 colors, each of those colors might be a SKU. Or it could come in a one design and apparel could come in a t shirt, a hoodie, a set of leggings, and a pair of shorts, right? But it has has the same design, has the same color, right? It doesn't have to be one variable changes to create a new SKU, but basically every unique product on the shelf that has a unique barcode is a different SKU typically. So you want to see trending of what's popular, what's selling well, what's selling out faster than we can stock, what is actually flying off the shelf, and what is just sitting there. Because just as much as you want to know what's selling, you want to know what's not selling, and you want to be able to evaluate if it's worthwhile to even keep it in stock. It could be that you've been sitting on inventory for weeks, months, even years that will not sell because it's just a product that hasn't sold in the last 6 months and it's just sitting there taking up space in your warehouse. Maybe your logistics company that's holding it is charging you storage fees for it and it's just losing you money. It's very possible. So you want to make sure that you're actually monitoring the different SKUs and basically anticipating as well demand fluctuations. So if you look at the trends over time and you realize that, oh, and this is very logical, I understand. This is a really like simple example, but oh my gosh, in May and June, our shorts go up and in September and October, the jeans go up. I wonder why, right? It's it's basically understanding the trends of your customers' behavior of when they're thinking of purchasing your product. I realize it's not always that obvious. Let's say you sell fragrances, for example. If you're selling fragrances, what will end up happening is you'll start noticing seasonality maybe in certain scents, or maybe you're going to start seeing spikes for holidays or spikes for Mother's Day or spikes for other types of events during the year, like graduations or birthdays, whatever it may be. You're going to start seeing patterns of people's buying. Right, because typically, consumers will buy in certain pockets of the year, especially around holidays that are associated with gifting, right? It's not just Christmas, but it could be Valentine's Day, it could be Mother's Day and Father's Day, it could be anything, and graduations, right? So if you can anticipate these demands, you can order enough stock and hopefully not too much to satisfy that demand, right? You want to minimize the risk of stockouts or excess inventory, and you want to make sure that you're optimizing your product mix to make sure you're meeting these demands effectively. Because if you are carrying too many choices, it can be overwhelming. But if you know which ones sell the most, you can actually push advertising traffic to those particular items. And I'm going to double down and say, let's combine tip number one and tip number two, gross margin and SKUs patterns to say, okay, what is our most profitable SKU, right? Which is our most profitable by gross margin? So, which one are we making the most money on per unit that we sell? How can we push more traffic to that? And how can we leverage the trends of these different SKUs to double down? So let's say you have a shirt and it comes in pink, and that shirt, that particular style of shirt, that variation, that SKU is the top seller, or excuse me, it's the top profit. So if it makes you the most money, let's just say that you take that and you go, you know what? It comes in pink. October is breast cancer awareness month. I have an idea. Let's push all of our advertising to that shirt that comes in pink, and we're going to double down on the highest profit item and a sales trend, right? So, how can you leverage these different strategies in order to make sure you're maximizing your profits and that you're taking advantage of these opportunities? Now, the third thing I'm going to talk about is called inventory turnover. Now, when I think turnover, I always think of the pastry. So I'm like, oh, I love turnovers. It's not like that. It's not as sweet. Inventory turnover really represents how many times you sell your average inventory during the year. So you figure out what your average inventory is in terms of dollar value. You can also do this in terms of units, but you can measure this as saying, okay, on average, we stock X in the warehouse. And you can compute that average by simply taking a period of time you want to do this for. So let's say it's a month. You take the inventory at the beginning of the month and the inventory at the end of the month, and you add them together and divide by two. You average them. So the average of the beginning and the ending, you don't have to track the average daily. That's excessive. You could just take the period of time, whether it be a week, a month, a year, and say beginning, ending, average those two numbers, right? What you do is then you take your cost of goods sold, you take the amount that you spent, the cost of those products that you sold, divided by your average inventory. What you're going to get is a number that's like 2.5, 3.5, 5, 4. Like you're going to get something hopefully in the single or double digits of just a number. It's a ratio. So what you'll end up with is figuring out this is how many times over that period, this is how many times you sold your average inventory. What this actually tells you is if you are selling your products quickly, if you're selling them efficiently, if you're not holding excess inventory, a low inventory turnover might suggest that you have slower sales or that your inventory management is somehow less efficient. So you might have higher carrying costs and you might have stock that's been sitting there, right? You're not turning over your inventory. It's when you think about turning over, think about tables in a restaurant, turning the tables. So it's just like flipping and converting it to new sales. How fast are you bringing inventory in and selling it, right? So you want to be looking at, is it high or is it low? Now, how do I measure, Shan, if it's high or if it's low? I'm going to give you a tip. Go to, I use a website called Ibis World. I pay for that subscription for my clients. We look at the industry metrics, but you can probably Google or you could probably ask ChatGPT now with a grain of salt because it's not always right. But you can probably search in your industry or your product type, average inventory turnover for a business in your industry. You can also ask your CFO, your accountant, for help with this. Figure out what your typical inventory turnover would be for your industry, and you can compare yourself to that and actually benchmark yourself. I personally love exercises like this because it allows you to kind of score keep a little bit. Now, I'm not telling you to obsess over comparison, but I am telling you that you can actually use this as a little bit of a check to see, hey, am I moving in the trend of my industry or am I above or am I below? Right. So that you can take action in order to correct that if you need to. You don't have to obsess over it though. Everybody is a little bit unique. Take it with a grain of salt, but it will give you at least some type of check to say, oh, okay, I'm pretty close to that. That's all I really want you to take away from it. So, as I mentioned, you got to be profitable. You got to understand the trends on what is selling if you have different product variations. And you have to make sure that you are efficient with your inventory management. This is huge. Inventory management is the key for product based businesses. And this is something that we do with our clients all the time as well. So, if you're exploring a product based business, do not be discouraged. There's a lot to unpack here, but it's so much fun once you get the hang of it to play around with this and start tracking trends and to look at performance and to get really creative with your strategy. If you find yourself surprised by how much you make and how little you actually keep, then your problem probably isn't your profit. It's your cash flow. Cash flow problems are the number one reason small businesses fail because they run out of gas in the tank. And that's why I released a mini course called Endless Cash that helps you quickly forecast your own cash flow using the same template that we use with our clients. If the pressure of launches and big investments stress you out, then grab a copy of Endless Cash and start getting ahead of those road bumps right now. Thank you so much for listening. If you enjoyed this episode, please leave a rating and review on your podcast platform. This small action goes a long way for podcasters to get our message heard by more business owners just like you. Be sure to check out the show notes for links to information about our guests and ways to get in touch with me. We'll see you on the next episode.